In 2008, the global financial system came closer to collapse than most people realize. A single bankruptcy erased over $600 billion in assets. Entire nations were brought to their knees. It was the year everything almost broke. It didn't begin with panic. It began with a promise that home prices would never stop rising. At the height of the boom, home ownership felt like a ticket to the American dream. Streets filled with new construction, open houses drew lines around the block, and every month seemed to bring a fresh record for home prices. The Federal Housing Finance Agency's index showed values climbing year after year, reaching levels 4 times higher than in the early 90s. Mortgages were easier to get than ever. 30-year fixed rates dropped below 6%, and lenders flooded the market with offers. Borrowers with shaky credit or even no documented income found themselves approved for loans with little more than a signature. Adjustable rate mortgages came with teaser rates as low as 2%, drawing in first-time buyers and speculators alike. By 2006, nearly 1 in 5 new mortgages was subprime, fueling demand and pushing prices higher still. Hopeful families stretched their budgets, convinced that rising values would cover any risk. In living rooms across the country, the mood was buoyant. People believed the good times would last, and few stopped to ask what might happen if the music stopped. Behind the scenes, a quiet machine was turning millions of household mortgages into something far bigger. Once a loan was approved, it rarely stayed with the original lender. Instead, mortgages were bundled together into mortgage-backed securities, each pool sliced into tranches, layers with different levels of risk and reward. The most senior slices, sitting at the top of the waterfall, promised the first cut of every payment. These tranches, by design, absorbed losses last. Investment banks took it further, stacking bundles of these securities into collateralized debt obligations, known as CDOs. By 2007, the market had issued 727 subprime asset-backed collateralized debt obligations, totaling around $641 billion. The majority of these senior tranches carried the highest possible rating, AAA, assigned by Moody's and Standard & Poor's. To investors worldwide, these bonds looked as safe as U.S. Treasuries, even though they were built from risky subprime loans. Synthetic collateralized debt obligations added another layer, using credit default swaps to create exposure without owning the actual mortgages. The result was risk repackaged and multiplied, spread invisibly across the globe. All it took was a stamp from the ratings agencies, and a mountain of fragile debt became the world's most trusted collateral. The facade of stability cracked in March 2008. Bear Stearns, once Wall Street royalty, suddenly found itself on the edge of collapse. Traders whispered about missing cash as overnight lenders refused to renew billions in short-term funding. On March 14th, the Federal Reserve stepped in, announcing $30 billion in backstop funding to keep Bear Stearns afloat long enough for a buyer to be found. By March 16th, the deal was done. JP Morgan Chase would acquire Bear Stearns for just $2 a share, a fraction of its value only days earlier. The rescue was swift, but the shock rippled through trading desks and boardrooms. If a firm as storied as Bear Stearns could unravel in a matter of days, what did that say about the safety of the entire system? Diversification, risk models, and AAA ratings suddenly looked flimsy. For the first time, the illusion of safety gave way to a new, uneasy question. Who might be next? At dawn on September 12, 2008, Lehman Brothers' Treasury team received the notice they had been dreading. Two of the firm's biggest repo lenders, JP Morgan and Merrill Lynch, were pulling $1.6 billion in overnight funding. An internal email flagged urgent raced through the trading floor. The cash gap had opened. By mid-morning, the Federal Reserve circulated a memo to the Treasury, warning that Lehman's net cash flow had slipped below the threshold for a systemically important firm. The legal team scrambled, searching for options. Chief Executive Officer Richard Fuld, face drawn, dialed into an emergency board call. He insisted there were buyers waiting. Barclays in London sent over a term sheet offering $10 billion in cash and $1 billion in preferred stock, subject to due diligence. Bank of America dangled a $30 billion bridge loan, but only if Lehman posted $50 billion in mortgage-backed securities as collateral. On the trading floor, the mood shifted from tense to frantic. Sell orders for $2 billion in mortgage-backed securities hit the market before lunch as dealers tried to free up collateral. The chatter on the desk was clipped and urgent. They said they were burning cash on these lines and they needed cash now. At 3 in the afternoon, Treasury Secretary Hank Paulson, Federal Reserve Chairman Ben Bernanke, and New York Fed President Tim Geithner met behind closed doors. Their public statement landed like a hammer. There would be no government guarantee for a private rescue. The backstop was gone. Barclays' next email cut their cash offer in half. Bank of America's lawyers pointed out that a $5 billion drop in Lehman's asset value triggered a collateral seizure clause, making any loan impossible without a full asset transfer. By nightfall, Lehman's chief financial officer sent a memo warning that if the firm could not close a transaction by midnight, repo lines would automatically terminate, leaving them with $2.5 billion in unsecured overnight debt. As midnight approached, the board took a final vote to pursue the Barclays deal if possible, or to prepare for Chapter 11. The countdown had begun, and every hour brought the firm closer to the edge. Over $600 billion in assets hung in the balance. The illusion of stability was gone. Panic was setting in across Wall Street. AIG's London office flickered with urgent calls as the numbers came in. The insurance giant faced a gaping hole, over $13 billion in collateral it could not post. On trading floors from New York to Frankfurt, banks demanded cash to cover credit default swaps tied to collapsing mortgage securities. Goldman Sachs, Societe Generale, and Merrill Lynch pressed for billions, draining AIG's reserves in a matter of days. When AIG's credit rating was slashed 3 notches, the dominoes began to fall. Each downgrade triggered new contracts. Each contract triggered fresh collateral calls. The world's largest insurer was suddenly locked out of the short-term funding markets it relied on to survive. September 16th brought a new shock. The Reserve Primary Fund, once the gold standard of money market safety, reported its net asset value at 97 cents. For the first time in decades, a major fund had broken the buck. Within hours, $41.5 billion in redemption requests poured in, threatening to pull the entire short-term credit system underwater. The SEC scrambled to authorize emergency operations. The Federal Reserve opened a $500 billion liquidity facility, and the Treasury issued a temporary guarantee for money market funds. These moves stopped the bleeding. Barely. Congress raced to act. After days of bitter debate, the House and Senate approved the $700 billion Troubled Asset Relief Program, known as TARP, on October 3rd. The Treasury gained power to inject capital directly into banks, buy toxic assets, and guarantee shaky portfolios. While lawmakers were voting, panic was already spilling overseas. In Reykjavik, Iceland's 3 largest banks, Glitnir, Landsbanki, and Kaupthing, collapsed into receivership between October and November. Their combined debts dwarfed the country's entire economy. Citizens lined up outside shuttered branches, watching the value of the krona tumble and capital controls lock their savings inside the island. The crisis had jumped continents, turning Wall Street's failures into a global emergency. Foreclosure filings swept across the country. 2.5 million homes were lost in a single year. Unemployment surged, peaking at 10%, leaving entire neighborhoods hollowed out. In Phoenix, a family watched their lives unravel when their adjustable-rate mortgage reset. Their payment jumped overnight from $1,100 to $2,200, more than they brought in each month. As home values dropped, their equity vanished, and the bank's notice arrived on a cold morning in January. By June, the house was gone to auction. Boxes packed, they left behind the backyard where their children learned to ride bikes. With credit ruined, they moved into subsidized housing across town. Stories like theirs multiplied in every city from Las Vegas to Cleveland. Families were forced out, jobs disappeared, and a sense of security was replaced by fear. The numbers told one story, but behind every statistic was a household, a history, and a future suddenly in question. Washington's answer arrived in the summer of 2010. The Dodd-Frank Wall Street Reform and Consumer Protection Act landed on the president's desk, its pages thick with promises of accountability. At the heart of the law, the Financial Stability Oversight Council assembled regulators from every corner of the government, tasked with spotting threats before they could spiral. The Consumer Financial Protection Bureau was born, charged with policing the fine print and shielding families from the tricks and traps of complex loans. The Volcker Rule drew a sharp line. Banks could no longer gamble with their own money, at least in theory. But as the ink dried, the pushback began. Bank lobbyists pressed for exceptions, and regulators carved out exemptions for market making and hedging. Ownership caps on hedge funds and private equity were eased. By the time the rule took effect, critics argued that its teeth had been blunted. Lawmakers promised a safer system. But the debate over whether Dodd-Frank truly tamed Wall Street lingers to this day. Today, global debt stands at a record $307 trillion, double what it was before the crisis. Markets chase stability, but fragility lingers just beneath the surface. The lesson: illusions can shatter overnight. In a system built on confidence, the next shock is never as far away as we think.